Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to Cut to the Chase. Today is Thursday, the 13th of August, and my name is Fook Hien. Overnight in the US, we had an important data point on inflation, or more specifically, it was the Consumer Price Index, or CPI. In the run-up to this data release, there was a fair amount of attention being given to it, but fortunately, the CPI data came out in line with consensus expectations. The data indicated that US inflation in July was 3.4% year-on-year, moderating slightly from 3.5% in June. While core inflation, which is excluding food and energy, was 2.5% in July, moderating slightly from 2.6% in June and the lowest level since 2021. Inflation is an important data point because it affects bond yields and the central bank's monetary policy, and especially with the Middle East conflict now and elevated oil prices, it causes some uncertainty on bond yields and monetary policy. What I want to discuss, however, is the impact of inflation on equities, and there are two main channels by which inflation affects equities. Firstly is earnings. Higher inflation, of course, would lead to higher costs for companies, but at the same time, companies are able to raise their prices. So the net impact for a company that sees its costs and selling prices rise by the rate of inflation is that the company's net profit will also rise by the rate of inflation. Hence, inflation leads to profit growth. However, companies with relatively stronger pricing power would be able to raise their selling prices by more than the increase in their costs, and hence such companies would see their profits rise by more than the rate of inflation, all else equals. Similarly, companies with relatively weaker pricing power would see their profits rise by less than the rate of inflation, or possibly even a decline in net profits. Hence, the impact of inflation on corporate earnings can be uneven, where companies or sectors that enjoy stronger pricing power will benefit, while companies or sectors with weaker pricing power will suffer. The second channel by which higher inflation affects equities, however, is a negative impact on all equity valuations. When inflation rises, bond yields will tend to rise, and a rise in bond yields will result in a rise in the cost of capital. A higher cost of capital will have a negative impact on equity valuations, and we've seen that many times in recent years when a sudden rise in bond yields lead to weakness in equity markets. Based on our calculations, every 0.25% increase in the cost of capital or the discount rate can negatively impact global equities by around 3 to 4%. The good news, however, is that we see strong earnings growth, which gives global equities enough cushion to absorb any yield-related shocks to valuation. Consensus estimates point to around 30% earnings growth in 2026 and 15% earnings growth in 2027. So barring a significant inflation spike, we expect earnings growth to offset any yield-related impact and to drive global equities higher, leaving us positive and overweight on global equities. The second quarter earnings season in the US is adding to our confidence, where it appears we are on track for another record in Q2. 85% of reporting companies have beat expectations, profit margins are at all-time highs, and earnings estimates are being revised up. Nonetheless, we recommend investors to be vigilant and not complacent, and to maintain a diversified foundation portfolio of different asset classes while staying invested. That's all I have for today. Thanks for listening, and I look forward to chatting with you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.